All right, welcome everybody to the Dynamo Capital Fund Update for June 2026. I've got Justin with Dynamo Capital and Brian and myself here. We'll get started. Did want to apologize for having to reschedule from Friday. We had a fluke power outage in the middle of the afternoon, about 3 minutes before we were supposed to get started, so that was really fun.
That sucked. That was pretty. Sorry about that, Justin.
No, it worked out just fine for me. I was all over the place too. So.
Oh, fair enough. We'll do a quick disclaimer. This is a confidential presentation. This is an investment targeted for accredited investors. It does involve higher risk. It's not a specific offering of an investment opportunity. And we are going to be talking about some forward-looking statements. You know, they are just that. They're forward-looking. We don't know what the future will present. And then all this information is coming directly from Dynamo Capital. So if you want to see this recording and previous month's fund update calls, tons of other data in the data room, head over to vycapitalgroup.com/data room and you'll find a ton of great due diligence information to sort through, probably more than you would like to look at, frankly. All right, so without further ado, we'll let Justin kind of take it from here and talk about June.
Great. Yeah, so as mentioned in the update, Q2 was a great quarter for the team. We broke records effectively across the board in revenue, originations, units, profitability, all of that good stuff. We did a great job. The sales team that we brought on over the last couple of quarters now has started to create those inroads in those local markets that we've been pushing them to make, and they've done a really good job at that. And our operations team has also been able to really work through that increased production without creating a tremendous amount more of the chickens with their heads running around or cut off and running around. But there was there's certainly a point in time where it always feels like 90% of your loans close in the last week of the month. June was not one of those months. Our operations team was able to do a great job of pacing the origination flow. So it was a very smooth month for us, which was great. Processes that we put in place a couple of months ago have started to show that they can handle scaling in terms of volume. So that's really exciting. So we feel very well positioned to be able to continue to grow and maintain this level of volume, and we're really excited about that. We also added two new positions as well, which is very exciting for us. We added a managing director of credit and risk, which is very exciting for us. So he will be working very closely with myself, Matt, and our managing director of capital markets to refine our credit policy in a way that allows us to dictate and really curate the flow of new loans that are coming into our portfolio to fit exactly what we're looking to fill. So rewriting our credit policy, not necessarily changing what's made us do well, but refining it in such a way that will allow us to really curate exactly the type of portfolio that we want in certain geographies, with certain leverages, with certain product types, in a way that will allow us to feel more comfortable, increasingly comfortable with the way that our portfolio looks. So very excited to have him. We also brought on a managing director of special assets. We've been very blessed to have a very well-performing book since inception, but with our increased production, our portfolio, as of today is right around $220 million worth of loans. 99.9% of the loans that we do go well. That 0.01% of loans, these are not true statistics, but you just for the sake of the point here, the 0.01% of the loans that go sideways take up 95% of servicing's time. They're very challenging. They're all unique. They all have very, very different circumstances and very different solutions as to how we can bring those loans either back to performing or how we work with that client to make Dynamo whole the easiest way possible. So we are adding a new seat in this MD of special assets to exclusively handle troubled loans. So any loan that goes past 60 plus days delinquent, this is going to be his territory. He comes with 20 years of experience in this field, He knows exactly what to do. He's a licensed attorney, and he's got experience in this very specific niche, in this particular asset class in the non-QM, DSCR, RTL space. So he knows exactly what to do, and he can devote all of his time to working with these troublesome loans. So it'll free up our servicing team. Our servicing team was very excited to hear that we were adding this position. So it'll free up much of their time to do what they do best, and allow him to do what he does best, and work very closely with myself and general counsel to ensure that we're making the best decision for Dynamo on these particular types of loans.
Very good. I definitely recall that as an account manager, having a troubled loan took up literally 80% of
Yes, it takes up I mean, orders of magnitude more time than the loans that do well.
For sure. All right, let's talk about some of these records that were broken.
Yeah. So, revenue up. Obviously, a big jump year over year. Just a little north of $2.5 million in fund revenue. Fund expenses up as well. Obviously, as our scale has grown, our expenses have grown. The vast majority of that is line of credit interest expense. So, which scales proportionally, obviously, with our portfolio. As we add more leverage to the portfolio, that number continues to climb. So that's to be expected. Our fixed expenses have been relatively stable. They were a little bit down in June. So, auditing, tax, all that good stuff, that's all included in those fixed expenses, fund admin expenses. So that's all included in that. Those are relatively stable at this point in time. And then fund profit, we broke that $2 million mark for the first time in our company's history. So really excited about that. Just a little shy of 2.1, way up year over year, obviously. Very excited for the team to have achieved such a figure. But the numbers are fine. The numbers are great. We're excited about that. But for us, it's just continuing to make good loans and just making the next right decision. And where the profitability lands is where it lands for us. So we don't have a particular profit target that we're trying to hit each month. Obviously, we're trying to just deploy the best capital or the most capital in the best way. And that's where it's landed for us. So we're excited about that. It was a great little kumbaya with the team on that front. And we went back to work and went out and found more loans.
Very good. Oh, sorry about that. Go. Finish this up. All right. So for origination and servicing.
Yep. So about $44.5 million in loan volume last month on 48 loans. So those are both records for us. So excited about that. Our TL portfolios as of the end of June is at 204. I said earlier it's at 220 today. So obviously July's been going on. So but 204 as of the end of June. All of our weighted averages have been pretty consistent. They're not necessarily moving too much in one direction or another. So loan to as-is value at about 80%, loan to after repair value at 68%, and our DQ rate around 6.3%, still in a healthy range. So we're
DQ rate the delinquency rate did tick up a little bit this month.
Yeah, it ticked up a little bit. We had a couple of borrowers that went sideways in June. That rose that up a little bit, but still within a healthy range. Our target is to be between 5 and 8%. Is a very healthy. That's what our banks want us to be under 12%. Is kind of the threshold at which they want us to be at. So we're well under half of that number, and we've got a good workout plan with those particular borrowers that went sideways. So we're already on top of those. And our team does a really good job of going proactive. It's not that loans are not going to go sideways. Loans are it is what it is. It's unrealistic for us to say that we're going to strive towards a 0% delinquency rate, because that means we're just not doing enough loans and we're not working with enough people. But it's a healthy number for us that we feel happy with. We'd like to drive it lower. Obviously, the lower the better. But we also want to make sure that we're not too conservative in the market. Right? That's a fine line.
Are any of those out of delinquency yet? Have they come
a handful have, yes. A handful we are working with that borrower to determine what the next steps are. He is there's one borrower that's got a handful of loans with us that went sideways, and we're working with him at this point in time to decide what the best strategy is for exiting those loans. whether it's if he's able to sell them, great. If he's not, then do we take them back, and what does that look like? So we're working through that process with him right now, and we feel pretty comfortable and confident with the position that we're in at this point on those assets. They're all in Wichita, so
that was my next question. Yeah, so they're all local.
they're all here in Wichita. So we know where all the assets are. We know exactly what's going on with them. So our team feels pretty comfortable with the position that we're in on them right now. It's just making the best decision for Dynamo right now as to what's the most economically efficient option for us to get out of these deals.
Okay.
Fair enough. All right. Kind of touched on this already. Still maintaining that solid 68% loan to.
Yep. It's been pretty consistent. It's fluctuated up and down a little bit, but as our portfolio's grown, it's really started to stabilize right around that mid to high 60s mark. So it has not fluctuated very much over the last couple of months, at least from what we've been able to see.
Gotcha. Okay. So what do you see for Q3?
Yeah, Q3 is going to be an exciting one for us. We got a lot of different irons in the fire. One thing that we're excited about is we're working on a securitization, which we're very excited about. So this will be a very, very big leap for Dynamo in really putting our name on the board there on the institutional side of things. So it'll put Dynamo's name in front of Wall Street, and we're very excited about that. So we're working on that. There's a lot of different pieces involved with that securitization. So it's been a very, very big team effort. There's about 10 of us that are working on this right now on the team, amongst obviously everything else we do. But we're very focused on getting that taken care of and done. At the same time, our pipeline continues to grow. We've got a really big, beginning of Q3 going on right now, at least from what we can see in our pipeline for July and August. And so, what we've done is, we've got to tighten the credit box a little bit and make it even more difficult for those loans to get in, right? We don't have an unending balance sheet. We can't fund $1 billion next month if $1 billion shows up. But we want to do the best loans that we possibly can, and that means tightening our credit box a little bit, right? Let's look at lower leverage loans. Let's look at borrowers with only the best experience. Let's look at borrowers with the highest amount of liquidity, so on and so forth. So tightening that box up a little bit, along with working with our new MD of credit and risk to really tighten the screws there and ensure only the best, highest quality loans are making their way in out of the pool that we have.
Can you, for just everybody that's going to listen to this, they probably have no idea what securitization is. Can you give us like the layman's terms, break down what exactly that means and what that is?
Yeah, I could talk for 2 hours about it, but effectively a securitization is what we're doing is we're taking and I'll use the numbers that we're using. We're going to take $110 million of our portfolio and move it into a different entity that's in the Dynamo, still in the Dynamo ecosystem. So it's still owned and serviced. It's still going to be on our balance sheet, all that good stuff. And effectively what we're doing is we're taking that $110 million pool of loans and turning it into a big bond. And we're taking that bond and we're selling it to Wall Street investors. So private equity funds, credit unions, banks, investment banks, or the typical buyers and investors in this type of product. So we go through a tremendous amount of due diligence, right? We provide them our underwriting guidelines. We give them all of the loan files, every single loan file, every single credit report, bank statement, appraisal, so on and so forth. And they check it against our underwriting guidelines to ensure that we are doing what we say we're going to do. And then we spend a shitload of money in legal expenses and book runner expenses. And so that'll be you'll see a pretty big blip on the expenses here over the next couple of months. Those will get amortized out over the life of the securitization, from what I understand. So it'll probably cost, realistically, probably cost us $1 million to get this done. So it's very expensive. But this $110 million pool, we will move these loans into the securitization. Bond buyers will buy these bonds, and it turns into effectively another capital source that we can utilize moving forward. So when Dynamo closes a securitization, we're going to stay in for 20%, so we're going to keep $22 million in those deals. $88 million is going to go to Dynamo, and Dynamo is going to pay off all the lines of credit that we utilize. So we'll basically completely wipe the slate clean of all of those lines of credit. We'll be left with excess cash of somewhere between $25 and $30 million after paying off all of those lines of credit, maybe a little bit more. And we'll take that money, that's just cash now that's sitting in Dynamo's bank account, that we can go out and make effectively another $110 million worth of loans, growing the size of the portfolio, increasing the interest income, increasing the origination fee income, without having to go and dilute the equity in the fund itself. So it'll be a committed pool of capital as well. So it'll be there for 5 years. So we'll have it. It'll be a revolving period for 2 years. So as loans pay off, we can go add more loans to that securitization to keep it full. And then at the end of the revolving period, all those loans will trail off and pay off. And then we intend to be a multiple time issuer, so we expect to do this again next year as well. And we can continue to go out and get committed capital. And what we like about it too is this capital is completely committed. So if one of our banks that we have a line of credit through goes under, then our line of credit is it's committed as of today. But if the bank goes under, then the bank goes under, and we have to figure out what to do with it, And we've underwritten our partners to the point where we feel comfortable with leveraging those partners. What's slightly different about the securitization is when that $110 million is there, it's there. It does not go away. There is no clawback, They can't do anything about it. So it'll be a cheaper cost of capital for us as well. It'll be somewhere in the mid sixes is what we expect it to land. And then as a first-time issuer, it's a little bit more expensive, we have to explain to people who Dynamo are and or who Dynamo is, who we are, why should invest in our loans, and so on and so forth. And then, but the next securitization that we do will be markedly cheaper, and also it'll give us slightly better leverage. So as opposed to staying in for 20% on the next one, perhaps we could stay in for 10% in the next one, which increases our ability to go out and do more loans with a cheaper cost of capital, and continue to grow the portfolio, and hit the run rate that we're looking for. If we want to do, just for example, if we want to do $1 billion a year of volume, and we want to hold every single one of those loans on our balance sheet, we'll have probably, let's say $700 or $800 million of loans on the balance sheet at that point in time. We'd need a fund size probably in the $400 or $500 million range to be able to do that amount of volume. With a securitization vehicle in place and multiple securitization vehicles in place, we probably only need to have $175 to $200 million of equity to be able to do that level of volume and still maintain a pretty healthy amount of liquidity at the fund. So it's an exciting step for us, and we're excited to continue to head down that path.
Are there
Oh, go ahead.
I was curious if there's any risk involved with this product, or is it pretty?
They're non-recourse, so it is entirely about keeping the loans that we do obviously performing. If we're doing non-performing loans, we're gonna have a problem. That's not our goal. Now we've had our underwriting guidelines vetted. They're well within industry standard. And this is not a new market. There's billions of dollars a year of these securitizations happening from a variety of different lenders. So this is not something new that Dynamo is coming up with. But the loans are non-recourse, and as long as we're underwriting to our guidelines, then we don't have any clawbacks. As long as we're not committing any frauds or anything to that effect, obviously, then we're going to be just fine. We're not, just to be totally clear. So I'm sure that was that didn't need to go said, but just to be totally clear. But yeah, we're very excited. So it'll be.
So the interest rate, so in the past you've used the lines of credit, to help fund loans, and used that as leverage. And I can't remember, I feel like those were at 7%, 6-7%, somewhere in there?
Yep, they're at SOFR plus 325. So I haven't looked at what SOFR is today. Let's see. It is 3.67. So we're paying 6.9% today.
Okay, so it's going to drop it to 6, and then eventually it's going to go even further lower with the bond.
Yeah, so we'll
issuance.
be at roughly the 2-year Treasury plus 275 basis points. So today that is let's see, 4.1. So 6.9. Actually, the cost of capital would be exactly the same. We're going to get better leverage though. More of our loans are going to be able to fit into that than what we can hold on our line of credit. So we'll get more effective leverage. And there is, the biggest lender in the country operates their business like this, Kiavi. They just got sold, but so their capital structure will probably remain pretty similar. Their cost of capital, their blended cost of capital is about 5.1%. And they stay in for 5% of the deal. So they sell 95% in bonds, and then they keep 5% in those loans. Will we ever get to a place where we're doing a 95.5? Probably not. But it's very realistic, and it's very well within reason that we could be at a 92 or 90 to 92.5% leverage on maybe deals 2, 3, 4, as Dynamo's performance continues to show in the market. And that cost of capital will go down as well. So the blended cost of capital will go down slightly. So will it get sub 6 into the 5s? Probably, as of today, probably not. We'll probably be in the low 6s. But our return on equity is going to go up because our actual investment in those loans is going to go down.
Right. Okay. So that basically loan yield is going to go up, right? Because of that.
Yeah.
Yeah. Okay. So that, as an investor listening to this is going to potentially mean higher returns for us.
I would say that is expected. Yes.
Okay.
So,
but that's going to take a while, I imagine, right?
We can't promise anything, obviously, but
of course not.
and asterisk, all that good stuff. We expect it to impact the yield meaningfully over a period of time.
Okay, and what's that period of time? Is what, 12, 18 months plus, or?
I would say 6 to 12 months. If we stayed on the pace that we were, raising the capital that we're raising, doing the originations that we're doing, we would expect that our portfolio could probably end the year probably around $300 million. With the securitization, assuming everything else stays the same amount of capital, the same run rate, we think that we could end the year somewhere around 400 to 450 with the same level of equity. So we'll have effectively a $1 million or $100 million bigger book than what we would have without the securitization, which obviously would translate to a higher yield net to the investors. So exactly how that'll pencil out over that 6 to 12 months, we don't have we don't have that down to the penny yet, but we feel pretty comfortable and confident saying that the yield will increase over that time frame.
Okay, cool. I had some questions. Are we at Q&A right now, Gina?
Yep.
Okay. So I had some conversations this week with some potential investors, and the PG, or personal guarantee, I think that's in your SOP, right? Is that something that's on all of your loans or some of your loans, or?
We do. We have personal guarantees on every deal. We don't do anything non-recourse.
Okay, excellent. All right. I was also asked about new markets. Like, what are you guys looking at when you guys decide, like Boston, for example, you guys decided to go into Boston. What is it that you guys are looking at metric-wise before you guys go into a market?
Yeah. We are looking very closely at the dynamics of the market. Who are the lenders in this market? Who can we find in this market that we like, that understands our culture, that understands how we think about loans? And what's a market that we feel pretty comfortable and confident owning property in if we have to? And what's a market that we feel like is going to be resilient towards any sort of sub-market distress that may occur. So as we're expanding into new markets, or as we have expanded into new markets, that's been the biggest thing that we're looking for. So we feel comfortable and confident in the markets that we're in today. We want to tackle a couple of new Midwestern markets. We want to increase our presence in some of the I-35 corridor north of Kansas City. So A gentleman from Nebraska, Omaha, Nebraska, just started today. He's a loan officer out in that neck of the woods. And then we want to grow into the Iowa market as well. And then continue to expand our presence in Oklahoma as well. So those are the only markets that we have a presence in already, but we want to gain a bigger presence in. Other than that, we feel pretty comfortable with the markets that we're in today, and probably not expanding too much further, at least as of this very moment. Now, as our capacity to deploy more capital grows, then we will continue to, obviously adjust that and look at new markets. It'd be foolish for us not to, continue to look at how we can continue to grow and what are the markets that are interesting, that are growing well, and have good positive activity in. We don't want to be the last of the dance, because that's never good. We also don't want to be first to the dance, unless it's the Midwest, because we like the Midwest, we know it very well, and we'll certainly be the first of the dance here. But I think there's some interesting markets out there that we have an eye on for 2027, 2028, for us to slowly expand into. So, but it's about finding the right people first.
Right. I asked you this probably 3 months ago, but do you know the market breakdown on the portfolio roughly? I mean, it doesn't have to be exact numbers, but
let me see if this is updated here. Of course it's not.
And guys that are listening live, if in the chat box, if you guys have any questions, feel free to drop it in the chat box. It's on the right side of my screen. It's either on the bottom or the right side of your screen is the chat. So that's there too if you guys have any questions.
My loan tape got all. We've been doing a serious amount of data analytics and loan tape rebuilding with this securitization. So all of my column references got jacked up, but I'm having our good friend Claude here update all those. So, is there another question in the meantime while Claude does its thing?
Let's see. You hit most of them. The fund expenses was a question, but you talked about that. That's all mostly interest accrued, and we can, like you said, we can expect some of those to creep up with the securitization. Let's see. The credit box. You guys were talking about tightening the credit box. What does that mean? I mean, are you guys requiring more skin in the game, or is it credit score or past history flipping houses or whatever it is they're doing with the money?
Yeah, a couple of things. We've split the way that we underwrite loans based off loan size. So actually 3 ways: asset type and loan size. So commercial loans get looked at one way, and we've told our team, if it's not an A+ commercial loan, we don't want to see it. Just don't even bring it in the door. It's got to be A++. They got to have a ton of skin in the game. They got to have a ton of liquidity, ton of experience, good high credit, all of that good stuff. And so our pipeline in commercial has thinned out tremendously on purpose. On the residential side, we split it between loans under $3 million and loans over $3 million. And we topped it out at $5 million. So we don't want to see anything over $5 million for the most part. We'll stretch a little bit over that if if it's compelling. But those loans over $3 million have to have a pretty serious skin in the game and pretty serious liquidity for us to feel comfortable with it. They also need to have experience in the particular asset class that they're doing, or in the particular type of project that they're doing. So we're not going to let somebody who's been historically flipping $200,000, $300,000, $400,000 houses to go out and build a $4 million house, right?
Yeah.
And do a ground up construction. That's not appropriate for us. Now, if they've got experience doing $3, $4, $5 million builds and they're coming to us, great, let's do it. Like we're totally interested in that because they know what they're doing, they understand the asset, they understand the project type, and ultimately how to exit that deal efficiently. But we want them to have a little bit more skin in the game on the front side of the deal to make us feel comfortable. And then on the stuff south of 30, we're really just refining what we've already been doing. So clients that have little to no experience, we want a little bit of skin in the game. We want them to put their money where their mouth is. We also want them to have a very experienced GC, so we're doing GC reviews via third party, so we can understand who the GCs are and understand their experience. And those borrowers that are already experienced, and nothing's really changed for them. So now we're documenting reserves as we have been, right? We're just formalizing that a little bit based off of the credit scores and matrices and that we've been building out. But so really a refinement of what we've been doing and a tightening of the credit box in certain areas that we want to see only the best of the best in.
Okay. So the securitization, let's jump back to that because I had a few questions about that. So if those loans are bundled and bonds are sold against those, right? It's basically collateralized, right? Is what that is. So Dynamo still holds first position on all those loans, right? It doesn't change that. So it doesn't really change the risk profile for us in any way, right?
Nope.
Okay, good. Gina, did you have any questions about that? I remember we were chatting about it. I can't remember what else came up.
No, I think I got what I needed out of that explanation. So.
Okay, so it's basically just replacing the lines of credit, really. That's all it is.
It's a complement to it. It's not replacing them.
Okay, so you're still going to keep lines of credit during the whole process. Okay, interesting.
Yeah, so we're going to take all the cash that we have that comes out of that and pay down the lines of credit. So we'll bring the lines of credit back down to zero. So it'll give us capacity effectively in the same amount. So right now we've got, what do we have? Let's see. Oops, that's not what I want. Nope, get out of here. We've got 50, 30, 40. We have $120 million of capacity in our lines of credit, roughly. Once our new one comes online, that we expect to close at the probably beginning of next month. We'll take that cash. Now there's a $40 million line of credit that we're getting ready to close. That's included in this. So right now we have roughly 80. We're going to take effectively all of that cash and pay down those lines of credit. So our lines of credit will be back to zero. We'll take the excess cash and use it to fund new loans to fill those lines of credit back up again. So that's the strategy that we're employing. And then once we get to a point where we're maxing out the lines of credit again because our loan volume is sustained at a very, very high level, then we'll go back to the securitization well again and do a second one.
Okay. And what is?
And then just keep repeating that cycle.
What's the metric on the leverage being used? I remember we talked about it in a ratio before, but I somehow lost that. It's
like for the fund level or on an individual loan level?
No, just let's do both. Let's just talk about both, just because I know we've got quite a few new people that are now on our distribution list. We're getting up to speed on how all of this works, so it'd probably be good to touch on both.
Our portfolio level leverage right now is probably around 55%. So if you look at each, there's plenty of loans. We probably have $35-40 million worth of loans that are wholly on the balance sheet, so we have 100% of that skin in that deal. We've got a good chunk that are leveraged up to the maximum, which is 75% of the loan. Not 75% of the ARV, 75% of our loans. If it's 100, if we did a $100,000 loan, that house should be worth $150,000 when it's done. We're getting $75,000 of our $100,000.
Gotcha. Okay.
So if you look at an individual loan, in some cases it'll be up to 75%. Portfolio wide, it's about 55%, taking into account a lot of those loans that we're either not getting full leverage on for any number of different reasons, or the loans we're holding on our balance sheet. And then in terms of the fund level leverage that we're targeting, we want to be in that call it between 2 to 1, 1.5 to 1 debt to equity ratio at a max. Is kind of our target. We want to be a little bit more on the more conservative side. We have some contemporaries that like to lever themselves up to the 4, 5, 6, 7 to 1 ratio, which is not interesting to us because if one cog goes sideways, then the whole thing tumbles down.
I don't like that either. That sounds a little.
That's a little aggressive for us. And so we think being that 1.5 to maybe 2 to 1 ratio is a good area to land. Most of our lenders don't want us to go over 1.5 to 1 anyways. And so it aligns pretty well with what our counterparties want. The securitization vehicle falls outside of that because it's non-recourse. So it's treated kind of funny, especially talking to our accountants. We talk to 2 or 3 different CPA firms, and they have different opinions on how those live in our balance sheet and how they're treated. Our counterparties, our line of credit providers, really like securitization, and they don't look at it as additional liability or additional debt, because we're moving it to a non-recourse trust entity that is set up specifically for these loans, and so there's no recourse to the fund if anything goes sideways on those loans. We just have a bad reputation for doing a bad securitization, which is bad in and of itself. And obviously, we're going to do everything we can to avoid that. As long as we maintain the same level of discipline that we've been able to maintain. But that is, that's how we're thinking about that right now.
So when you say non-recourse, just for anybody listening to this, so that basically means that like I don't know, say 10 loans in a 100 loan package went sideways.
Mm-hmm.
They can't come and call that note, like for that whole
Correct.
package, right? That's what you mean by that, non.
Yeah, that
okay.
They can't. They cannot. The collateral that we're putting into the pool, into the securitization, so the $110 million worth of loans, that is the collateral that they have. So they cannot come to the fund and say, hey, these 7 loans went sideways, or these 50 loans went sideways, and we're only able to get $80 million of our $110 million back. You need to cough up the other $30 million, right? That's not going to happen. So the pool that we put in there is the collateral that they'll have. And if some black swan event would happen and some of those loans lose money and they're not able to get their entirety of their principal back, then they're not, they can't come to Dynamo Capital fund and get excess money.
Gotcha. Okay.
And our lines of credit are set up very similarly as well. Now, they are they're non-recourse to the fund, but they have personal guarantees from myself and Matt and from the manager entity. So we're removing those in this transaction with the securitization. So this is not I wouldn't say this is necessarily a more or less risky thing than our lines of credit. If anything, it's probably a little bit less risky because of the committed nature of it. But we're not taking on any, we don't feel like we're taking on any excess risk by adding that vehicle in.
Okay. And so the target is going to still stay the same, 1.5 to 2.0 to 1 on the leverage then, even with the securitization, or is that going to ratchet up?
The securitization is going to fall outside of that. So if we do, the $110 million securitization is not going to be counted against, doesn't technically classify as debt on our balance sheet with the way that they're set up. So they will not be included in that ratio. Our target for that is going to be lines of credit, right? So we want to be, if we have a $100 million fund, we don't want to have more than $150 to $200 million in lines of credit against that.
Gotcha. Okay.
Of utilized credit anyways.
I see.
So.
Okay. I don't think I have any more questions here. I didn't see any in the chat box. Nobody's dropped anything in there that I can see.
Okay.
But
well, I can jump into the returns then. The month of June, the Vy Dynamo 1 split was 1.91 after fund expenses. So what that means, if you were at a Class B, that extrapolates to a 1.72% return for the month, or 20.6 annualized. And Class A investors, under 250 is a 1.53% return, or annualized at 18.36. So still slightly exceeding our targets. So we'll keep taking that. And then we wanted to announce that we are still accepting capital. We do a monthly close, a raise and close each month. The fund has been open now 7 months, and SEC guidelines allows an SPV like ours to be open for 12. So that means through November 30th, we will be continuing to take capital. We hope maybe to reopen a new fund next year, but we'll have to cross that bridge when we get there. But if you're thinking about it, I would just recommend submitting a soft commit. You'll find the link all over the website, and that will at least get the ball rolling. Let us know what you're thinking about. It's non-binding. It also triggers some documents to be sent to you so that you can review those and understand what the PPM document says and how it reads. So yeah, so feel free to pick up the phone, give us a call if you have questions, or if you're thinking you want to move forward. The soft commit is that next step. So I think that's all we have for today.
All right. Well, thanks, Justin.
Yes,
appreciate it. Sorry about the power outage. Send that apology to Matt too. I don't know if he was there for that one, but no, I think you're muted, but
Sorry. Thanks, guys.
there you go. All right. Have a good one.
Take care.
Thanks everybody for joining. See you guys.
Thanks.